Hello, everybody, and welcome to our monthly Davos expert call. For June, we have a very special guest, Phillip Anderson, who wrote the book, The Secret Life of Real Estate and Banking, which was my introductory education to real estate cycles when I read it. And it's a very good book, and I'd like to ask him about how some of the lessons from that and his analysis since then apply to the current real estate cycle. So the first question that I have for you is,
Yeah, I Nick. How you doing?
which is, where are we currently in the real estate cycle?
Currently in the real estate cycle, pretty much midpoint. We've had the mid-cycle slowdown, and we're about to get seriously started with the second half. Really, it's been the first half was a carbon copy of all the other 11 or so before it. They all last about 18 years, and I'm expecting the second half to go pretty much the same way.
So I would say that that's in line with the timeline. But the thing is, at least in certain parts of the United States, we're already at maximum capacity of rent and mortgage affordability. So do you think there's going to be any regional variance that occurs? Because I just don't see how much higher you have in places like it could go in places such as Southern California, whereas more middle America, I think, could double or triple from here.
Yes, I don't always know the regional specifics of the US state by state, but most of the real estate cycles they recover from the most populous centers first. So New York, San Francisco, Los Angeles. And also particularly in centres where the expansion of those cities is limited. And then the second half, usually we see the second half is led with regional centres. And I found it a little ironic with the COVID stuff that happened. It automatically drove people out of cities and into regional centres. And you're right, it has to be affordable. So, the spots that didn't really recover from the 2008 downturn, they'll take centre stage now, and so the regions will start catching up with the major urban centres, and until everything reaches a point in about 6 or 7 years' time, everything will reach a point where it can no longer be afforded.
So that basically kind of aligns with what your cycle theory, that again these second tier regional markets are going to see a lot more upside. Because I noticed in the 2000 to 2008 rally in housing, San Francisco was the worst performing market because it had already gotten bid up from the tech boom, and the best performing were places like Las Vegas, Phoenix, and a lot of Floridian cities where the affordability ratios are much more favorable.
Yes. You could reasonably expect that to repeat. The places you'd look at this time, I would expect, or I would anticipate, is where outside of urban centres, cheap land can be platted and subdivided, and the craze will go there.
Yeah, and then the next question that I have is, how does changing inflation expectations influence the housing market?
I'm not sure that inflation expectations actually has much to do with the housing market. It's much more attuned to affordability, interest rates, and probably the most important thing of all, availability of credit, and especially in America as well. There's another variable as well, because the United States is such a dynamic country, a dynamic place, and it's a very inventive sort of place, and you have a highly functional stock market, or place like Wall Street, where they're specialists in bringing new ideas and new companies to market, and it can create a lot of real wealth through stock market and shares and things. So that can have a big influence as well, and I think much more than in inflation expectations. And real estate property markets, they can't get fully underway. They don't recover fully from the prior downturn, which we had in 2008, 2009, until that wealth is created. And it usually takes the first cycle to start seeing the wealth come again and the banks recover and new stocks come to market. Then the wealth gets created and then somehow in the mid-cycle downturn, people reassess their lives and their how things go, and you seem to get a sea change in opinion. For example, you can see after the mid-cycle slowdown in 2000, 2001, you saw the events of 9/11, and it sort of it changed people's expectations and opinions of things. 1982, the mid-cycle slowdown in the cycle before that, 1982 changed all our perspectives as well. That was when inflation peaked, the bond markets peaked, and then we had a sea change in attitude and investment methods as well. And you can go back as far as 1961 as well with the credit squeeze. 1960s, the 1960s was a fundamentally different era than what the 1950s were. You go into the things like rock and roll started in 61, 62, the nuclear scare with Cuba, and then 63, the assassination of JFK. Just completely changed people's views and opinions and what they were going to do. And the second half of the cycle usually gets a bit more hedonistic, and events seem to happen to drive that. I'll trace that back to 1800 in the US, and it just always seems to repeat the same way. And now you're having a situation where, with a pandemic, that people are reassessing their lives. They don't want to go back to their old job. They like working. Understandably, which I've been doing since I can ever remember, is working at my own pace, a bit like a digital nomad type. I don't have to work from the office. I can do my own thing. There's a lot of people reassessing that type of thing now, and also able to make profits and money from basically anywhere if you've got the skill to do that. I think those things have much more influence over the housing market than inflation expectations. And of course, the new way people look at things now after COVID and the lockdowns and everything else, that will also suit working from regional places too. So I don't bring inflation expectations into the way I look at housing and property and markets. So I don't think that's going to have much effect.
Okay, so you said that you say we have another good 6 years left of housing price appreciation. What's your starting point cycle? Because if we use the bottom at 2011 here in the United States, wouldn't the peak be then in 2024, 2025 at the latest?
The cycle's 18 to 19 years. I measure it not just in stocks and real estate, but 18.6 is what it comes out at. The usual scenario, and this has been pretty exact since 1955, once the housing market in the US over there, once it sorted itself out after the Second World War. 1955, it's 14 years up, 4 down, roughly 14 and a half, something like that. I think, and of course there'll be regional variations, but I think the US market overall, the bottom, as you say, probably the end of 2011, mid 2012, 14 years up, I think will take us to the end of 2026. And you don't need to, that's the theoretical model, 14 years up, 4 down. This was measured by a couple of other people that nobody seems to have heard of these days, Homer Hodge and Roy Winsley. They documented it in their own thesis, in their own books. Fred Harrison did it for the UK. I've done it for the US. It's been pretty good, 14 years up, 4 down. So you can take as a basic outline, basic forecast, you could take 2012 and say 14 years up. But when you get to 2026, one of the specialties that I have, one of the things that seems to have helped me and what's made my, Secret Life of Real Estate and Banking, the book, what has made it so useful, I include the stock market and how the stock market and real estate interact, and you can see this at the extremes. And so, for example, at the real estate low points, it's the stock market that recovers first. It's common sense, really, because that's the most liquid type of area, and it takes property, a year or two, and sometimes more, to sort itself out. So, real estate last cycle took 4 years, roughly, from 2008 to 2011, 12, to sort itself out. Real estate's last to recover, but usually at the tops, I tend to suggest that at the extreme tops, real estate is the first to peak, but not real estate per se. It's the land prices that are first to peak, and this is what real estate people don't do. Real estate people don't know how to understand the stock market, and I usually find stock market people can't understand real estate. You either do one or the other, but I've been able to integrate both of these things, and the stock market will tell you if the real estate cycle is about to peak. You'll be able to read this in the stock market. So I don't think you'll be having to guess. We do the basic. I do the basic theoretical model: 14 years up, 4 down. And as we get into 2026, the stock market's going to tell us. It's going to tell us quite clearly. The warning signs will be there. The rough 2011
housing prices led the stock by almost 2 years.
Yes. Yeah, I think that's reasonable. Certainly 12 months. Yes. It isn't housing prices, it's land prices. You have to differentiate. You really do have to see the difference between the economic rent in land prices and the structure built on top.
So the next question is, the one question I have about why this cycle may break is, what if global central banks decide to never tighten policy, or always have negative real interest rates and have them progressively get more negative? Could you kill the housing cycle if the government is going to literally pay people adjusted for inflation to buy houses indefinitely?
Yeah, that's a good question. I don't get that asked very often, but it's one that definitely needs some thought, and it could play a bit of a role going forward. There's two parts to that. First up, the basic theoretical, but it's not just theoretical. The basic reason why the property market does what it does is to do with the enclosure of the economic rent. In other words, the yearly earnings capitalised into price, and again, it's the economic rent, the land price. It takes all the gains. So if the government and other people are going to do as you say, and the banks, and give people money or some sort of universal benefit of some sort, and then pay people to buy houses, yes, that could go on indefinitely. But again, the gains will be taken. So at some point, the gains historically have become just out of reach of the average worker. Now, as you say, if it's a bit different this time, and yes, with interest rates where they are, and they don't look like they have to go up much, and the Fed can keep printing keep buying all these bonds and printing all this money and everything else, it does look like the party could go on forever. But if you've read my book, the one thing I learnt, and I had a fantastic time writing that book. I wrote it in different states when I was visiting in the United States through 1997 through to about 2005. It's a remarkable place, and it's got a fantastic history. It is really amazingly what occurred to me. 50 different states. But the one thing I learnt about it all is, the one thing I learnt writing the book and touring around parts of the US I was in, The book taught me that the real estate cycle, it found a way to repeat. And let me just give you this scenario about what might repeat going into 2026 or a little bit beyond. I would be looking for the possibility of an event whereby the Fed and the US government didn't have the ability to lower interest rates any further. Now, I don't know what that event could be. I could speculate and say it could be something related to the US dollar. There's plenty of other countries around the world that have had a run on their currency, and the first thing that a central bank does is lift interest rates to protect the currency so that it doesn't free fall. America's never faced this situation before. You've now got a competitor with a lot of people, being China. You've finally woken up that you have to start improving your infrastructure. You have to start improving the great productivity you already have, but you've got to take it further. As I see it, the US, the government and the Fed, they may not be up. Some reason might come up. And I hate getting negative because I'm a pretty positive person overall. I'm a bit like Warren Buffett that way. I would never sell America short. It's always going to be positive. But just there might be a short-term hiccup where for some reason, the Fed has to put interest rates up, whatever that might be. I've got no idea what could happen, but something could. I'm speculating. I don't know. I'm just saying that what I learned, the biggest learning thing I had when writing my book, putting it all together, was the events happened within the cycle to cause it to continue to repeat, and repeat it has. I can give you another example there of current history with this cycle. If you can cast your mind back to 2014, 15 and 16, when everybody in the US was so negative, people thought that the US dollar, that it could collapse, the euro could collapse, and nobody could see further in the future too much. And the banks weren't issuing credit, weren't doing much. And then along comes Donald Trump, and he just got everybody to focus on other things, focus on himself as well, the stuff that he brought with him. Suddenly people forgot about the past and started looking forward. I mean, you either loved him or you hated him, but still it got the whole country looking forward into what they could do, and it got them out of that funk that a lot of people were in, a lot of US citizens seem to be in, that hadn't recovered from the prior cycle downturn. Does that make sense? Do you see what I'm trying to say there? With I just think there'll be some event that will just create the circumstances where rates just might have to be lifted.
How the inflation being going high would be the catalyst for that. But the next question is, why does the 18-year cycle work as well as it does? I read in your book is because that the average real estate speculator and professional only doesn't live to see two cycles in his career. But with the age of the internet now, doesn't that lengthen the memories of all participants?
Well, this is possible. We'll have to see what happens. I confidently right through the very early and confidently through the late 1990s, very early 2000s. I said the cycle would only run 14 years up. It would peak around the end of 2006, 2007. And I got too hard and stuff. But you may be right this time. There's no guarantee, I guess, that it sort of has to do it. I documented in my book.
Not whether it will work or not. It's like, why do you think it's so consistent? There's a couple of reasons. There's three reasons, two of which I'll discuss, one of which I just can't put forward, I don't think. People don't change their habits, and the incentive to chase the economic rent is pretty powerful, and it hasn't changed, and it's not going to change. And there must come a time when the earnings of real estate capitalised are just too high for Labor to afford.
And the second reason is the long-term average return of land is about 5%, and over the years, interest rates have averaged about that. When you capitalise that rate, it comes out at about 15 and a bit years, something like that. So that seems to be about the average. The third reason I'd like to go into, but I don't feel I can go into that here. If people, if people are interested to follow that through, they're welcome to go to my website and have a bit of a look. propertysharemarketeconomics.com. And I for my subscribers, I start to discuss why I'm so confident all the time in talking about the 18-year cycle. It's got to do with esoteric reasons, and I just don't think I don't want to go there today with that stuff. But it's fascinating. I can tell you, it's absolutely fascinating. Really, seriously, it is.
So, how does leverage and level of debt affect the magnitude of the cycle on the way up and the way down? Because in the previous cycles, such as the 1950s, the savings and loan crisis, and in the late 90s, those downturns really, you had maybe a 50% most upside and a 20% downside because leverage was low. But then the leverage levels got way higher in the 2007 cycle, and we got a national correction of over 35% in the real estate market.
Yes.
And now the global debt levels are even higher than then. So when we do have this bust, are we going to see a 4-year period of 50% or more decline in real estate? Or does the level of absolute debt and leverage have no effect on the magnitude of the cycle?
Oh, no, the cause of the cycle is the enclosure of the earnings, but what drives the volatility, the violence going up and down, that's bank lending, that's credit, creation of credit. So leverage and quality of loans absolutely affects the cycle in terms of violence and volatility. But caveat to that again, it's the last 2 years of each prior cycle. It's what the term Fred Harrison came up with, and I've agreed with it. It's called the winner's curse phase. It's the final 2 years of the cycle where things get a bit crazy, where people start pledging gains that they haven't been cashed in yet. Now you'll get companies that or directors start buying out other companies, and they pledge the shares they've got and the shares of the company itself. You'll have a situation again, probably, I think, where loans are not documented properly. And so if that gets serious in the final 2 years, for whatever reason, so, I don't know, let's say a lot of large companies do copy Elon Musk, and they start accepting lots of crypto currencies and things, or let's say for some reason these things are accepted and payments get made and the values get right out of hand. If that goes into overdrive and then people start pledging cryptocurrencies for the purchase of a house, or then let's say a system comes up, which I probably think has already started or will start soon, whereby buyers get the chance to let's say house prices do get really go up from here even more, which I think they will, and sellers start to find that buyers can't afford the selling prices. Well, what would stop 6 people getting together and then buying 1/6 of the house? And they buy 1/6 of the house with the architecture underlying the cryptocurrency, so it can all be documented and it can be done legal. So there's absolutely no doubt about who's got title to the 1/6. And then we start to agree that this 1/6 of a house can be actively and fully traded. And let's say that's all done on the stock market or wherever it gets done. Let's say a lot of the big major US corporations that own a lot of the housing, let's say they wanted to start selling off half at a time. All these sorts of things could start happening. Now, those sorts of things is leverage. It affects the quality of the loans. If that gets out of hand, we're going to see, it'll turn, and that's where the cycle just just repeats. And again, you can see the history I've traced with the US real estate cycles. The other thing you can see is every cycle has been larger or bigger than the one preceding it. And we're just seeing the same thing again. So I would expect leverage and quality of loans to again get right out of hand, and you'll just see that all that eventually turn.
Do you expect any variance between the U.S. and international markets? What are your thoughts on some of the international housing markets out there?
Well, me personally, I think some of the international markets could go a lot higher yet. I mean, you know what it's been possible for me to do in London, for example, the property I've got there. It's a no-brainer now to refinance the loans I've got with some of the property, and you can take your repayment down from about £700 or £800 right down to £300 with refinancing of much lower rates. I mean, that has to drive house prices up even higher. And in Australia now, where I'm originally from, affordability's as good as it's ever been in the past 35 years. And people want to talk about prices coming down. It's just not going to happen. And there'll be areas of the US as well. I've got no idea which ones. I'm not a specialist in regional US, but there'll be areas that people find that can be exploited, which they'll do, and it'll level everything up. So you know, I can see things. You know, the international will still catch up yet, and then I just got a feeling that, like everything else, it'll peak at the same time. You know, all the world's involved in the cycle these days. But what we haven't got yet, and this could be another development too, we haven't quite reached a stage where Chinese banks are international, not as well connected in the market. So, but if that were to happen, if Wall Street, you know, Goldman Sachs and other firms, if they started really trying to inch their way into Chinese banking and all of the retirement savings, and Chinese people have to retire, and there's a lot of them going to be retiring. You know, this could internationalise the whole cycle, although I suspect that might be the next one, not really the current one. So again, you know, I think towards the end of the cycle, the areas where the most speculation takes place, that'll be the area that feels it first. And you can judge the areas where the most speculation is, because you can judge that by the height of the buildings. So where the world's tallest goes in, that's where you see the biggest fall, probably.
And the last question before we go to open it up to Q&A. My theory on this house, this is an idea I've been thinking about, and I'd like to run it by you, is that what a lot of people think of as housing bubbles, is it really just a disguise of the decline of living standards and the falling of real wages? Because if you look at third world countries, the average price to income ratio in the poorest countries in the world for housing is 30 to 100 times the median income. Whereas in the United States, historically one of the more prosperous country, it's been 3 to 6 times before the 2000 housing boom. And it gets as high as some cities as 10, which is relatively low. And then Europe is about 7 to 11 historically. And then and China is about 20 to 30. So is the fact that the recent rally, as they stated, starting from 2012 to present, is it really a housing speculation increase in prices like a typical cycle? Or is this really just the market repricing people's value and labor just that much lower, and that our living standards are going to have to devolve to emerging market countries? Is that the end game for the housing market? Because that seems for me, for housing, is that poverty goes up, because that's the only way you can sustain high multiples, is if you have more people forced to live in a smaller unit together, or just an acceptance of lower living standards.
Yeah, tough questions there. The remarkable thing about the United States that I found is that the further inland you went, the better the land got. certainly from where it was initially settled, from New York and then going west. So it allowed things, it allowed, in the New World there, 1800s, 1900s, it allowed wages to be high and housing costs to be low. That went on as far as till virtually the settlers got to Kansas, really. And then still overall in the United States, you've still got a lot of land. In Australia, further inland we got, the worse it became as far as desert and droughts and everything else. In the UK, all the land is already enclosed. So I tend to feel that the United States found a great way with the freedom loving nature of the peoples, the frontier mentality, and the open space and things and credit banking. They found a great way to house the people and all the new settlers and things. You also managed to create an environment where a minority of people didn't exploit the richness of the resources. You go to some of the South American, African parts of Asia and things. You've basically got a strongman in control, and he owns all the resources and he exploits it for himself and his family. The United States, Australia, parts of the UK managed to, and other great nations who managed to avoid that, have basically pretty much housed their people very well. Yes, you've got, I know it's not equal, and I know there's pockets of the United States and Australia and other countries desperately poor. But overall, I think generally it's not that hard overall to at least afford a place somewhere, start off initially renting and then work to owning your own home. So I don't see it as a decline of standard of living. It's just that these things go in a cycle, I've noticed. And since 1800 in the United States, every 18 to 20 years, there's been a downturn in real estate led by overvalued land prices. And that happened whether there was a central bank, no central bank. It happened whether interest rates were high or low. It happened under whether the country had a gold standard, whether it didn't. All those things are irrelevant because it's to do with how much the earnings of land get enclosed and then sold off and allow credit to be created on. So generally, as the cycle turns, it has lifted people's living standards until we reach a peak. And I think the next one, 2026, and after that, those people that bought late, they're going to be in trouble, as the past tells you. They'll be too much credit, over leveraged, over mortgaged. They'll do it tough. So I don't know. Housing bubble, decline of standard living, hard to say.